Good evening. Thank you for joining Corporate Connect. I'm Eileen and I'm a host for today. This evening, we welcome CapitaLand Integrated Commercial Trust, as well as our audience from Facebook Live. This webinar is organized by SIAS and supported by SGX Group. We will kick off today's webinar with a presentation by Mr. Jeff Howie, Market Strategist from SGX Group on recent market highlights, followed by the corporate presentation by Mr. Tony Tan, Chief Executive Officer from CICT, and we will end off with a Q&A session. Well, everyone knows that CICT is the first and largest real estate investment trust listed on the Singapore Securities Trading Limited, with a market capitalization of 13.6 billion as at 31st July 2023. It owns and invests in quality income-producing assets, primarily used for commercial purpose, including retail and/or office, located predominantly in Singapore. Currently, CICT's portfolio comprises 21 portfolios in Singapore, 2 properties in Frankfurt, Germany, and 3 properties in Sydney. Australia, with a total of property value of 24.2 billion, based on valuations on its proportionate interest in the portfolio as at 31st December 2022. Without further ado, I now invite Mr. Jeff Howie to give an overview on how the market performs. Over to you, Jeff.
Thanks so much, Eileen. I'm also very much looking forward to hearing from Tony and the team very soon. So I promise not to take too long and just run through a quick overview of the REIT sector here in Singapore and the recent developments. This disclaimer is pretty much the same one SIAS flashed a couple of minutes ago up, so I won't go into it. What I can report on is that REITs are continuing to attract robust investor activity. The sector still represents around 12% of the total market capitalization of the Singapore stock market. And pretty much in the year to date, the day-to-day turnover contribution is around 19%. So 19 cents in every dollar that's gone to work in the Singapore stock market so far this year has gone into the S-REIT sector. And that 12% contribution to total market cap and 19% contribution to turnover of the 40 trusts or so that make up the REIT sector, it is comparatively high compared to global markets. And since the end of 2019 through to the end of July, the FTSE EPRA NAREIT Global REIT Index, it has declined 5% in total return, while our iEdge S-REIT Index has also declined 5% in total return. So those 3 years and 7 months saw comparable returns, but I should mention that the Singapore and the Global REIT Index, they have averaged something like a 0.70 120-day rolling correlation coefficient, and it shows that there is an element of differentiation in the day-to-day moves of the indices for portfolio managers. As many as 17 of the trusts exclusively invest in property assets outside of Singapore. We have 20 of the trusts investing in properties in both Singapore and outside of Singapore, such as our guest tonight, and the remaining 3 REITs are investing purely in Singapore. For the international exposure, this includes as many as 14 trusts with properties in Australia, 11 trusts with properties in China, 11 trusts with properties in Japan, and around 9 REITs, or trusts, I should say, with properties in the US. So across the REIT sector, 80% of the trusts own and manage overseas assets from across Asia Pacific, the US, and Europe. So it makes S-REITs now one of the most international REIT markets in the world. Nonetheless, the Singapore AUM of the S-REIT sector is large, and the recovery momentum is a key driver for the sector's performance. In the second quarter of this year, Singapore real estate sector grew by 12% year on year, following a 7% year on year expansion in the first quarter of this year. That has been supported by private residential property, as well as the commercial office, as well as the industrial space segments. For local property assets as well, Singapore tourism activity is poised to recover by 2024. While we're focused on the Singapore REITs, one Singapore-focused industrial REIT that has recently made news headlines is Sabana Industrial REIT, with 2 resolutions passed at a landmark EGM. First, to remove Sabana Real Estate Investment Management as the manager of Sabana REIT, and secondly, to internalize the management of the REIT. So when that internalization is complete and it has a process to go through with further EGMs, it will mark the first REIT to have an internal manager in Singapore. Although I think back in 2016, Croesus Retail Trust, which was a business trust, not a REIT, did undergo their own internalisation of the manager, but those assets were gradually divested and the REIT was delisted. So looking at internal REIT managers across the world, by comparison, they are popular in the US, Canada, the UK and Australia, but Japan and India require their REITs to be externally structured, and Hong Kong and Singapore are, well, up to had been 100% external, though there were no requirements for that. In terms of what market commentators have been saying, Morningstar believes it is still too early to tell if this transition process for Sabana REIT will lead to further internalisation, I should say, of the REIT manager functions by other REITs. And DBS Group Research also believe that while unprecedented, the case for internalising the Sabana REIT manager was unique to Sabana, and that a new trend is unlikely for right now. So our overall S-REIT sector is pretty much well diversified by the type of property in the portfolios, and with that, it's great that we have CICT with us tonight, because they are a prime example of taking 2 REITs that were focused on particular property types and combining into a diversified S-REIT. And diversified S-REITs also now make up the largest subsegment of the REIT sector here in Singapore. So we have 9 diversified trusts in the S-REIT sector now, and that makes up about 40% of the day-to-day trading turnover in the S-REIT market. That's the diversified REITs. So it's geographical mix and multi-asset portfolios, as CapitaLand Ascendus REIT maintains, allows the manager to diversify risks across industries, customers, as well as currencies. The 40 REITs and the property trusts of the sector, they ended July with an average gearing ratio of 37.9%. That's below the regulatory limit of 50% if your minimum interest coverage ratio is at least 2.5 times. The average yield of the majority of the 40 S-REITs was at 7.8% at the end of July, discluding the peripheral very high yields that have been on the back of the lower performances of certain REITs. And much of the 20 plus years, I think, of the success of the S-REITs has been attributed to their comparatively high distribution yields. And of course, meeting the institutional and the retail investor appetite for dividends. I think just over the last 1 year and 7 months since the end of 2021, the S-REIT sector alone has booked more than 2 billion Singapore dollars of net retail inflow. For the recent earnings season, it's seen one of the S-REITs, which is Manulife US REIT, halt its distributions for the first half of this year because of a breach of its loan covenant. And this REIT is now focused on, the US office properties as well. At the same time, we've had an S-REIT that is mainly focused on data centers, that is Keppel DC REIT, reporting a record first half distribution per unit, while at the same time leading the gainers within the S-REIT sector for the year to date. So we've had a lot of mixed moves within the segment this year, and that's, as we said, you would expect that, given the element or the layer of diversification that we have at the property type, as well as where the properties are located across Singapore and across the world. Within the S-REIT sector, it's data center and diversified REITs have recorded the strongest DPU growth from 2019 through to 2022. Keppel DC REIT's DPU grew 32%, and it recorded consistent increases from 2019 through to 2022. Parkway Life REIT's DPU has been rising uninterrupted since its IPO in 2007 and grew around 9% from 2019 to 2022. And Mapletree Logistics Trust and Mapletree Industrial Trust DPU also grew around 10% from 2019 to 2022. So the three S-REITs subsegments that did book the highest gains between the end of 2019 and the end of July 2023 included data center REITs, healthcare REITs, as well as industrial REITs. On the interest rate front, the interest rate hikes may also peak at some point. Despite this some mid-year uptick we're seeing in advanced economy gauges for inflation, overall inflation is trending lower, and the majority expectations are that the US Fed funds rate is now at its peak. I think there's only 30% expectations that we might have a 25 basis point hike by the time of the third FOMC, which is at the end of the year, the third FOMC to come, the end of the year, the December 13 December FOMC. So at the moment, majority expectations are that the current rate is peak rate, and expectations are also that the FOMC will start cutting in the second quarter of next year, with potentially 4 25 basis point cuts in 2024. But there's a lot to happen between now and there. But that's all based on guidance and comments by the Fed chair, the current FOMC voters, as well as the 4 incoming FOMC voters for 2024. But back to Singapore, and the red dot, it does maintain a highly responsive, progressive regulatory framework here. We saw quick action by the MOF, IRS, and the MAS announcing S-REIT supportive measures back in April 2020 amid the volatility of COVID, on the onset of COVID. The S-REIT sector has still grown at a compound annual growth rate of 7% over the past 10 years, with the FTSE ST REIT index maintaining a 10-year total return of 70%. And many of the S-REITs also have a long track record in some cases, of proactive capital management using acquisitions, disposals, and asset enhancement initiatives to enhance and grow unit holder value. And I think that makes the right segue now to bring Tony in. So thanks very much for your time again. Any more info you'd like, here's our QR code, but I'll stop sharing now and hand this over to Tony. Thank you.
Hey, hi guys.
Thank you,
Hey,
Jeff.
hey, hi, Harvey. Hi.
Yeah. Yes, we will just hand over the time to Tony. Tony, so glad to hear from you. I know that you have just announced your first half 2023 results. So over to you, Tony.
Sure. So I thought this is going to be a fire chat session, and I probably don't want to spend too much time on the results, and I would prefer to give the opportunity to participants here to have questions, any kind of burning questions. If I can address it as much to my ability, I'll do that. I think it's a little bit more interactive in a way so that we can learn from each other. There could be certain perceptions or certain things that the participant may have, perhaps need to see some clarification. I hope I'll be in a position to do that. So I'll just give you a very brief overall view summary, and then I'll prefer to go straight to the chat, if you don't mind. Would that be okay?
Yeah, sure.
Yeah. So I think overall, the results says for itself. CICT has been able to ride on a little bit of reopening play. It is a combination of factors that are arising coming out from the COVID, and naturally, I think the performance of Singapore in the global stage stand up quite well, and hence many companies to start looking at where Singapore should position vis-a-vis where they want to be in this part of the world. I think we pretty much stand quite tall. So first half result, to a large extent, we are riding a little bit on the coattail on the tailwind effect. Naturally, we are looking at the global environment now. We're facing some of the points that Jeff had touched upon earlier. The interest rate movement has been, I must say, quite significant over the last 6 to 9 months, and obviously the impact to the global economy, the impact on overall business sentiments has been quite significant. And on that backdrop, I think we have been quite busy trying to look at how we could look at our own portfolio construct, what makes sense today, what may not make sense going forward. We have been doing things to essentially optimize the performance of individual assets, putting up mid to longer term plans. What are the areas that we can improve on? We have just completed some enhancement work at Raffles City, and we're seeing a nice positive uplift, contributing to the results significantly in second half last year and this first half this year. And of course, we have embarked on a new AEI at Clarke Quay towards the end of the last quarter last year, and we're looking to complete it later part of this year. And hopefully going into 2024, we will have a little bit of kicker coming from Clarke Quay. Against this backdrop, that will be some of the things that potentially can have a little bit of positive impact coming in. But from optimization of performance of the assets, we have also been chalking in quite nice reversion, on the back of a more positive sentiment in Singapore, both on the corporate side, in the context of looking at their office footprint, and also the retail side on the back of a reopening play, and of course the borders that has been gradually been relaxed in the course of last year, and towards this year we're seeing more and more inbound traffic coming in. So hopefully that will give a good base as we ride through the second half. At the same time, also looking at new potential growth area that we can ride into. So I think I'll give you a little bit of snapshot in terms of how we look at our own business. Naturally, we hope to continue to ride on potential, the tailwind effect that may come, as Jeff mentioned. Hopefully we are closer to the end of the interest rate cycle than the middle. And hopefully that will have a bit of spin-on effect on the wider economy, and hence overall the momentum that we have been riding on since late last year into this year will be able to help us to carry through in the second half and the year ahead. So I think I'll just stop here. Perhaps we are happy to go into a dialogue, right?
Sure, Tony. Let me just invite Mr. Ang Hao Yao. He's our honorary secretary from SIAS to moderate tonight's Q&A session. Over to you, guys.
Hi, Hao Yao.
Hi, Tony.
Hi.
Well, thank you for that presentation. I will go straight into the Q&A, and I think sure. Usually we will first cover distributions. So I think there are some questions sent in beforehand, and investors are wondering, what do you think of the trend of your distributions? Is there a dividend policy? I suppose that's quite a simple question. I'm just going to group a little bit so that you can answer them more or less at the same time. I think one asked whether there could be a frequency change to 4 times a year, like in some stocks, and for any potential increase in DPU, perhaps through overseas acquisitions. Over to you.
Okay, so quite a few loaded questions there. So the first question, dividend policy. At this moment, there's no real intent to relook. I think we have announced, so it was back in 2021, that we have moved from a quarterly regime to a half-yearly regime. I think there are pros and cons in terms of how that will impact from the business perspective. Let me tell you the positive aspect. On the quarterly basis, naturally, if you look at the stock price movement, it tends to be quite sensitive to when the dividends are announced and ex-dividend. So from that perspective, quarterly distribution does have in a way, more calming effect from a stock price movement perspective. So for investors who like stability in terms of the stock price movement, quarterly income actually can be viewed positively. But for investors who look to do a little bit of more proactive kind of transaction, then that stability may not be there. I mean, that's a positive part in my view. The other positive aspect of a quarterly result is obviously ability more in a timely manner to inform the investors about the situation on the operational level and how does that translate into the financial numbers. The negative effect from a quarterly to is that immediately there will be drawdown of cash quite quickly. From a REIT perspective, in the current interest rate environment, actually it can be a big drag because then you have less flexibility to be able to manage your cash in a more effective way, given that every quarter you have this volatility in your cash flow that will go in and out versus today, the 6 monthly. That's one. Second part, the additional cost impact to having that quarterly account to be reviewed by the auditor, that's another aspect of the cost that have to be taken into consideration. So I think there will be a bit of positive and negative on both ends. But I think ideally we still want the investors to look at this more holistically for us, in a longer term view, and don't want to be distracted by every quarterly movement in numbers, and hence moving into a half yearly does try to shift the focus back into the focus on the fundamental on the mid to longer term basis. So that's what currently I think the management is thinking. Obviously, we will at some point we'll always come back and review whether this policy still remains relevant. Yeah. The other questions.
Potential trends.
Sorry, I missed. Sorry.
Yeah, no, I was just saying that there was also a question about the trends, and I think you were just about getting into that. The trend of the dividend for the distribution trends. Distribution trends. Do you have any idea on the trend of?
So if you look at our first half result, if we have been tracking pretty strong organic growth on MPI level, it's gone up by 10%. One of the biggest component that's eat away the distribution has been the interest costs. And we have been trying to manage the interest costs as prudently, as effectively as possible. So that resulted in a distribution increase of 1.5% vis-a-vis a 10.1% increase in MPI. So if you want to extrapolate that against the other matrices that we've been clocking, the rental reversion, the increasing contribution from some of the assets that we've been ramping up operation, if we do the annualization effect, then highly likely our second half result would not end up any worse than the first half. So that's one takeaway. But going forward, there are a few things that we are working on that's beyond 2023 and 2024. A few things are quite certain. Look at the top line revenue side. We have been clocking fairly healthy rental reversion that should translate into a higher rental growth at both the retail side and on the office side. We are also riding on the reopening of the border across and reactivating a lot of cross-border travel. So we should expect increased foreign visitorship coming in, and the inbound travel should increase vis-a-vis the first half. And that should contribute positively in terms of contribution coming from the retail segment, at least especially in the downtown location. On the flip side, there are certain elements that we're managing, the expense side, right? On the first half, what we have clocked in on the expense, a few components that are critical. One is the energy cost, which is one of the highest percentage of our OPEX, representing about 12 to 13%. On the second half, you should expect the rate that we are locked in 16% lower than the first half. And that will translate also in 2024. So second half of 2023 and 2024, the tariff rate that we managed to lock in is 16% lower than the first half of this year. So that should translate, all things being equal, manage your energy consumption prudently. That should translate into a lower energy expense. Second part of the expense that we've been managing very prudently as well, and it's also affected through the change in the property management agreement, which we have put up to unit holder to approve, which is essentially to take away the the staff cost responsible for looking at the leasing of the basically the tenancy leasing, and compensate the property manager through deals that have been closed. So you have a more direct matching between the revenue side and the expense side. In the long run, that should translate into a lower cost, fixed cost, and that should bodes well from the operational aspect. So we try to manage the top line growth, we try to manage the expense line, and these two will translate into, hopefully over time, improved margin into 23 and 24. On the interest rate side, that's something that we are watching carefully. As you probably know, we have recently, late June, announced a 7-year bond issuance. We know it's always very tricky. We have been over the past years or so managing our interest cost exposure, interest rate exposure quite prudently, always maintaining a very high fixed rate in a very low interest rate environment. And in fact, we extend our duration as far as possible on the fixed rate side. When the interest rate situation started to shift, we started to pare down a little bit on the fixed because the yield curve has been very volatile. And today we have about 78% of our interest costs being locked in, coming down from as high as 95% a few years back. So we will be prudently trying to manage this interest rate dynamic as much as possible, because that's, I think that's critically important in an environment like today where interest rate is moving quite actively. So what we did in the 7 years essentially is to lock in a fixed rate opportunistically, because during that period of time there were high demand for high grade issuance in a 7-year tenure at an all-in rate of 3.93%. Vis-a-vis, if we were to keep our rate on the floating side, we probably will be expensing in the range of about 4.5% to 4.7%. So there will be already an immediate positive carry by switching over now from a floating rate to a fixed rate. So we will constantly monitor that. Hopefully that will translate into a lower exposure going forward in the interest rate volatility. And hopefully that will translate into a lower impact on the distribution line. Yeah. So I have touched upon the top line, I touched upon the expense side, also I touched upon the capital management side, so that we address all the different lines that ultimately will translate into the distribution. So I can't give you a forecast. We'll manage as prudently as possible. I think we have locked in some certainty. Nevertheless, we are watching the 2024 tower. In fact, as we speak today, we are actively monitoring whether there are windows for us to again look at any kind of participation in the interest rate side. Yeah.
Well, thank you. Actually, since we're on this graph that you put up, I noticed that there's, for the next few years, there will be an increase in the proportion of unsecured loans. So how does that actually benefit the trust, taking more unsecured loans as opposed to secured loans?
From a cost perspective, it doesn't make a big difference, purely whether to go on a secure or unsecured basis. You're looking at the bank financing, right? Usually from bank financing perspective, there's a little bit of halo effect, because CICT, being one of the borrower, essentially will command a little bit of risk discount, I would say. Most of the secured financing are at the property level, and a few of them reside at the in country. For example, in Australia, we have some secured loan. In Germany, we have some secured loan. At our joint venture level, we also have some secured loan. So those will be managed actively. We always have the flexibility to unwind the asset level loan and move it up to the trust level loan. That flexibility is always there. We will monitor the situation, whether there's any advantage to do it at the trust level or do it at the asset level. and proactively manage that as efficiently as possible. From a credit point, let's say from a rating agency perspective, an unsecured loan actually has a bit of credit enhancement. That means in the view of a rating agency, they view that by having as fewer as your asset being set aside for secured financing, then the rest of the participants who are participating in your bond issuance, for example, will have a fairer chance to get the same bite in the event of any kind of bankruptcy. So from that perspective, actually, as fewer secured financing is deemed positively from a credit agency perspective. But nevertheless, we would have to look at the situation. Sometimes if it's a joint venture, unfortunately, it has to be done at the joint venture level. If it's a joint venture, and hence they will be at the asset level. Yeah.
Thank you.
I hope that's clear.
Answer actually.
Yeah.
Yes, it is. Thank you. Because now there's quite a number of questions around WeWork, and the questions are about what is our exposure, what are our plans if they do intend to, for example, pull out, and perhaps you can also talk a bit about our exposure to other kinds of co-working spaces companies.
Yeah. So I think WeWork has been in the limelight, unfortunately for the wrong reason. But they also came out quite publicly that Singapore, I think, has been profitable. In fact, I think there are a couple of times I think there have been attempts for them to separately look at carving out, the Singapore and Asia Pac business or separately from the US listed company. But nevertheless, I think the news coming from the US, we used to watch, and see what they're doing. Within our portfolio, they're doing okay. In fact, Funan almost full occupancy. At 21 Collyer Quay, where they are the substantial part of they are the main tenant over there. They are doing quite okay. Almost 65% of the space has been leased out for the entire building, but they do have 3 floors that are currently not renovated. They don't have not had put a specific plan to renovate. So we are watching and we have been interacting with them, engaging them actively to see what's their game plan. We do have the security in place in the form of security deposit, which we can obviously activate in any kind of eventuality. But nevertheless, we are keeping a close watch on what you want to do next. And to put into context, a situation like WeWork is not something new. I mean, as a landlord, we always would face a situation where, in most cases, it's actually a tenant going into financial trouble, and what we call a re-entry, we'll just essentially move in and over the space, and you can either let it out, or if somebody want to take it over, I think we can always work out some kind of arrangement. So it's not something unique and something different. The only difference in this WeWork's case is that it could potentially be a situation where the shareholder, means the shareholder of WeWork entity in Singapore, become insolvent, right? So theoretically, in Singapore, they can function as it is, because if you have a shareholder and if you have a profitable business in context of Singapore, and they are not relying on the shareholder for funding, I mean, theoretically, they can move on their own. I mean, that's in reality, right? So we are not overly worried at this point in time, given the fact that the underlying business is still fairly robust in Singapore, and in our property specifically. In a worse situation, we'll move in. Theoretically, we can move in and we can take over the space. We potentially can also start engaging directly with their subtenant and have a more direct relationship. So those are some of the things that we potentially can do, but ultimately we will see how things pan out from the US side. Yeah.
So we'll follow on to that would be, what are our exposure to other kind of co-working space companies, and what do you see the trends in that sector?
So we do have other relationship with with TWT, the workspace. In fact, they are in a couple of our buildings, and they are doing very well generally. The co-working space scene in Singapore actually has been quite healthy. They are feeling that demand gap now in the space where, in a highly uncertain business environment, where companies are looking at different kind of working space configuration, and whether they should looking at commitment on a longer term basis, long-term contract and a big space requirement. Many companies are taking this opportunity to plant themselves in the co-working space, which allow them that flexibility and the shorter duration from a lease commitment perspective. Concurrently, given a high cost of capital environment and lesser credit availability situation, I mean, not everybody have good access to credit. Coming to lease a space and having to incur a capex can be increasingly an issue for some potential tenant. Hence, again, agile workspace operator like the WeWorks, the likes of TWT, we call it an agile workspace operator. They fill in the gap quite nicely because they take care of the front end, they take care of all the renovation. All the occupier need to do is come in, you can sign a contract, you can sign a 3-month contract, sign a 6-month contract, sign a 1-year contract, and have the full flexibility at the end of it, whether you want to extend or in the midst of it, you can always negotiate a way to cut it short. So the exposure is not overly onerous for occupier. So today, I would say the co-working space operator are effectively capitalizing in a situation like that and move into the marketplace. In fact, they are looking to expand. Most of the co-working space operators are looking to expand, including some of them who are already our tenant. But their model may differ from location to location. Let me give you an example. TWT is one of the main operator for us. They are our tenants in our buildings like Capital Spring. So the relationship between us and TWT is a landlord-tenant relationship on a long-term contract. But they are also managing our space in Capital Spring. We actually allocated a floor for them to manage, and we underwrite essentially the occupancy exposure. And we find that that's been quite useful way of tapping, varied demand coming from the occupier who may or may not have that strong conviction today to lock in a longer term kind of or more permanent contract on a longer term basis. And we can fulfill that space requirement in the different spot of building that we have, whether it's within the co-working space that TWP manage for us, or within TWP space where they will have certain kind of configuration that may suit certain tenants more effectively. So I think the agile market actually has been quite vibrant. And if you look at some statistics that's been published by some consultant, I think it was CBRE. Actually, Singapore and Sydney are the two main cities where adoption of flexible work arrangement has been the most active. And they have been very active in these two markets, which is why I think WeWork were quite early on when the news about the US came out in the news. They were quite quick to come in to say that actually Singapore, they had no plan to downsize. So when we engaged them, are you prepared to downsize? They came up publicly say that they are not prepared to downsize the exposure in Singapore. Yeah.
Given the high growth in the co-working space segment, is it possible or feasible for you to get into the space directly?
We are effectively getting the space into the space directly by having an operator managing that space for us. right? So instead of the traditional way where we go and sign up leases with tenant, co-working space will scan the market on the different kind of needs. They try to do the matching, and if it fits into our space, they fill in the gap. So that's one option. Ultimately, how that will be suitable for different assets will all depends on the strategy for different building and the assets. And we had been trying out, we started the experiment in Capital Spring by having a space concurrently being leased by them, but at the same time also managed on our behalf, so that we have the full flexibility and see how that pans out. Because a lot of landlord actually likes to talk to, a lot of tenants actually likes to talk to landlord who are able to give them a more complete solution. So let's say they have a business plan, 3 to 5 years, they're looking at kind of business growth projection, and they may require certain space over a period of time. So if you are able to line out what are the possibility for them, including temporary residing in certain space while waiting out their existing space that they intend to vacate in other building, we have that full flexibility, because some of the space effectively is the landlord space that's managed by the co-working space operator. So in an environment like that, where companies are beginning to adapt to a flex space business model, flex working space business model, I think it's highly effective proposition and a very efficient way to engage the same tenant and try to provide a full suite solution. Yeah.
Thank you. Well, we're looking at some trends. The last few years, of course, work from home is very popular now. How is that affecting your office market?
So far, I think there's been different more way that company are adjusting. Some company may naturally adjust downward the space requirement that they foresee they will need for foreseeable future, if they allow, say, a 2 days kind of configuration, 3 days office, 2 days work from home, and hence the total foot per square footage they may need maybe a 10-20% reduction. But we also have cases where a company will look at the whole workspace design. Ultimately, they look at what's the full objective, what kind of sector they are in, what kind of culture they want to create, what's important to them from an employee engagement perspective. Even though they deploy a flexible work arrangement with their co-worker, the actual square footage of space may not be reduced, because there is all about looking at whether that current existing space makes sense. If not, it doesn't make sense. What needs to be enhanced upon. It could be a enlargement of social space, for example, right? Space that is important to attract worker back to the office, or it could be other amenities that may be provided to employee. So they may have reduction in, let's say, number of desks, right? Because you don't need 100% of the desks all the time. So the total desk required may be reduced, but then that space that has been given up may be redesigned into some other purpose. It could be meeting, it could be breakout space, it could be social interaction space, it can be cafeteria, right? So different company will adopt different strategy. So I think it is still a evolving scene. Although the flexible work arrangement seems to have more entrenched into many parts of the world, not just in Singapore, but the way company respond, I think, is quite varied. And we've seen a variety of different strategies that's adopted. Secondly, I think from a demand side, in fact, Singapore has been quite fortunate over the last 2 to 3 years, in a way, in fact, benefited quite significantly from a market standing perspective. In the global scene, as a result of the management of the COVID situation, as a result of things happening around the region, all the political tension, Singapore became quite an ideal location for companies to look to present themselves in Singapore and to manage business out of Singapore, whether it's in Southeast Asia or in the Asia Pacific. So growing importance of Singapore role, no longer just a financial center, but as a business center, is increasingly taking shape. And hence, we're increasingly seeing companies started to either, if they are not already in this part of the world, when they decide where they want to plant their flag, Singapore definitely be one of the top choices. If they are already here and they have multiple locations, some of them are started to look at consolidation into location where they could be more effectively manage the risks around the region. So on a net demand perspective, that's been very healthy. Importantly, also we have to look at the overall net supply situation, especially in the office environment. It's very tightly controlled. I think URA is quite clear in their plans, where they want to have more commercial space. And downtown CBD is naturally not the where they want to grow their office footprint. And if we look at some of the last 2 years of new land supply that's been put up in downtown location, Marina location, for example, I think they are all geared towards residential. So the supply going forward in the next 3 to 5 years will be pretty tight. Any new supply coming to the market are going to be likely to be old stock. They'll be taken out from the market and then redeveloped into something new. It could be a mixed use, or it could be a more refreshed, larger footprint offering. But certainly there will be stock that will be taken out from the existing market, and hence existing occupier who are in all this older stock will start looking at what are the other options. So on aggregate, the supply situation will be pretty tight in CBD, and hence CBD location, I think, will continue to command a little bit of premium over the rest of the market. So that's how we look at it. If we go beyond the CBD, gradually you can see some sub-market coming out. I know that's the interesting play, and then of course we would assess whether there are opportunity for CICT to get involved. The region around Bugis is coming out quite nicely with some new supply that came in, whether it's Guoco Midtown or the new revamped Shaw Tower, right? So that will create a different kind of dynamics. There'll be some shifting of some commercial entity that they like downtown location, but they don't necessarily have to be in CBD location. So some of these peripheral surrounding location become more interesting. Potentially, there's also an area that we may see whether we can take opportunity and ride on it as well. Yeah. So I think in a nutshell, the market is pretty healthy in Singapore. We do not have a lot of space to offer. We still get leasing inquiry. Currently our occupancy in the office building is about 95.4. It is going up because as you close at 30th June, there are a couple of contracts that we're still negotiating. And if you close it, I think we potentially can see a higher occupancy in the third and fourth quarter. Yeah.
Thanks. Perhaps we can move to another topic. There's a bill passed in Parliament, is it, about the retail premises bill, I think it's called, and it requires compliance with the code of conduct. And how is that going to affect our business here in Singapore?
No, actually, for us, it's business as usual. In fact, we were the earlier adopter since June 2021, when the draft plan was out, the code of conduct to govern the lease structure. We have been the early adopter. So from CICT's perspective, we are already operationalizing all those things that's been mentioned. Potentially that will be legislated. So for us, I think it's no impact at all. Yeah. From that angle, there's no impact because we already operationalized it. Yeah.
Basically already complying with it.
Yes, correct. Yeah.
How about the another big topic perhaps. The sustainability trend, how is CICT planning to kind of initiate green activities, incorporate green features, energy efficiency increases and so forth, perhaps heat, handling the heating issues and so, perhaps you have something to comment about. And I know you're undergoing some refurbishment for Clarke Quay, and as you mentioned, you also just completed one for Raffles City. Perhaps give the investors an idea of what your plans in this area.
Yeah, so I think these are critically important, especially for institutional investors who will definitely penalize us if we are not even on this journey, right? So to us, sustainability and all the related climate-related topics, I think something we have to deal with actively. So we already put out a statement, by 2030, we do have certain target in terms of energy efficiency, water efficiency. I mean, these are the target that we are working towards too. And on the longer term basis, 2050, we also have the aspirational target, 2050 net zero, right? So if you don't want to have that kind of commitment out there, I think first thing first, you probably get punished by the big institution funds because they potentially can't even invest in CICT, right? So to us, this is already part and parcel. In fact, it's left, right, center of your own business strategy. Make sure that you have to be on that journey. Question is, how are we going to reach that target? So we have a 2030 target, we have a 2050 target. In between, we know trajectory-wise, we are working towards achieving those targets. But in between, we are also very pragmatic, right? Because a lot of this target means either you got to decommission some of the equipment and put in a new equipment, right? So there lies the trade-off. And our buildings, 99% of our buildings are rated green. It has got a green credential. With the exception of 1% that's in Australia, the small component of a mixed use, which is a retail component. But 99% of portfolio has got the green credential. And the green credential has got different levels, right? You just like a rating agency, you have the A, you have the B and the C kind of rating agency. So we have some that achieve the A-rated agency equivalent platinum, or you can even have A plus like the SLC, right, which we are working towards too. But you also have the credential that are maybe BBB investment grade. Then you'd be the likes of Gold and Gold Plus. So we are quite pragmatic how we want to over time right through this journey. Each one will require some level of capital commitment to upgrade, to improve the operational efficiency. That may mean also bringing some of the aging equipment down and reinvest into it. So we do have lined up our plan in the next 7 years or so until 2030. What are assets that we want to do to put priority on? And we may be prepared to live with sometimes 1 or 2 assets dropping off from a platinum to Gold Plus, but we know in the long run, we are working to achieve a level that will be acceptable by the occupier. These days, the occupier, so where earlier I talked about investor, if you are not even on that journey and you are not even having that aspirational commitment to hit the net zero, then you are potentially not even investable. When it comes to occupier part, beginning to see the trend of tenants, especially corporate tenants, right? Asking you, where are your commitment? Where are you now? You are, for example, today you are Gold. We need your building to be minimum Gold Plus. Tell us by when are you prepared to put in the investment so that they will be accountable to their underlying stakeholder as well. Because they are also embarking on that journey, and they also have, but especially those big companies, multinational companies who have given out their commitment out there to their stakeholder that they are also embarking on this sustainability journey and be a very responsible citizen to the climate change. So we would have to ride this journey along with them, but more pragmatically, how we executed it, that we will be very tactical. We do have a 7 to 10 year plan on capex upgrade, and we will be circumspect when we want to bring some down and put in the necessary equipment at the right time. Because it's a trade-off, right? If you bring, let's say a useful life of the equipment is 20 years, even though it's 20 years, but it's 10, let's say, even though you run it down to 10 years, it's still actually quite efficient. But for a 20-year good equipment, prematurely bring it down just to fulfill that incremental uplift in your rating, I think is not financially prudent. And it doesn't make a lot of economic sense sometimes, just to sacrifice that financial impact for that upgrade in that rating, while we know that at some point in time, we definitely will have to do it. So the question is whether should we prolong it and bring forward. So those are the trade-offs that we have to make along the way. So your point is, Hao-Yao, this is a topic that when we engage investors these days, it's always been raised, where are you in the journey? One of the biggest challenges for Singapore, by and large, is that we are still utilizing essentially brown energy, because Singapore doesn't produce enough renewable or green energy to cater for the all the industry needs, and hence there's a need to secure renewable or green energy outside of Singapore, and we're currently actively looking at some option that potentially would give ourselves that opportunity to lock in renewable and green energy for long term, and that will bring us closer to the journey to the net zero.
Thank you. Perhaps I have a last related question to this. Will the trust be able to benefit then with all your plans and strategy in the sustainability space to benefit from green financing? How's that market, and are we tapping on it? And how does CICT stand in that market?
Yeah, I think we have been actively increasing our green financing, whether it's in the form of a green loan or green issuance, the debt issuance. And in order to achieve that, obviously you got to fulfill certain criteria. So we are looking to increase our green financing naturally when those expiry tower that comes in 2024. For example, the more recent one we did in June is also a green financing. Yeah, the MTN loan issue that we did in June, 400 million. That's a green issue. Yeah, so we will be active in the space. There's going to be increasingly more pressure from the financial institution also to provide a differentiation between green and non-green lending. And we are seeing some effect, a little bit, very marginal kind of basis point improvement in terms of spread. But I think in the longer term, the capital market, which is a debt side capital market, will eventually recognize that, because they would also be forced by market forces to be part of the journey, and their investment portfolio has to contain mostly green related financing. And with that increasing demand that we expect to come from the marketplace, we think there will be more room to see income in terms of the financing savings between the green and non-green kind of issuance. Yeah.
Thank you, Tony. And I think we've come to the end of the time allotted for this. I will hand the time back to Eileen.
Thank you, Tony and Mr. Ang, for the colorful Q&A session. I think we are running out of time. I can see a lot of good questions being asked tonight. So you can still reach out to CICT's Investor Relations directly if you have further questions. I'm sure they will be happy to address the questions that you may have for tonight. So without further ado, we want to thank the panelists tonight for sharing with us. For the audience tonight, in case you missed any of tonight's sharing, you can also rewatch at our YouTube channel or at our SIAS website. And of course, Corporate Connect is our monthly webinar. Do visit our website to get updates on our upcoming investor education programs and initiatives. The upcoming Corporate Connect will be featuring United Hampshire US week next week on 22nd August. Without further ado, I just want to thank everyone. Have a good evening.
Yeah, sorry. I mean, if there's some question that we didn't manage to answer, I think I'll get our IR folks to compile the question and then supply the answer appropriately. Yeah.
Certainly.
Yeah.
Thank you so much.
Thanks a lot.
Thank you, Tony.
Thanks, guys.
Thank you.
Bye.
Bye.
Thanks everyone for joining.
Bye.